Are you as excited to get started talking about job order costing and how we can record the journal entries? I'm sure you're not, but we're going to do it anyways. In this chapter, we're going to discuss the cost flow of job order costing and how we actually make the numbers go onto the books of the company, which means it's going to be a flashback to journal entries and T accounts in this chapter. A student's favorite thing to do. So there are 7 important vocabulary terms we need to start out with. They were introduced in Chapter 2. Job order costing is the costing system we use when we make very different products that are not the same, meaning we're not using a production process that involves mass production. Instead, we're making unique products. Absorption costing is the type of costing method where direct materials, direct labor, and all overhead costs, both variable and fixed, are included in the cost of the product. So in Chapter 2, we talked about allocating cost to a product, and we were including direct materials, direct labor, and then all overhead costs, including both fixed and variable. That process that we learned is referred to as absorption costing. The allocation base is the measure we use to allocate our overhead to our jobs, which is usually direct labor hours, machine hours, or it could be direct labor cost. Those are the common ones that are used. The predetermined overhead rate is the rate that we use to allocate overhead to our jobs throughout the period. And remember, we calculate the predetermined overhead rate using estimated overhead over estimated activity. It's estimate divided by estimate because remember, we're using it to allocate overhead to our jobs throughout the year, but it's determined at the beginning of the year before we have the actual numbers. The overhead application process is done by taking the predetermined overhead rate times the actual activity, which is the amount of the allocation base incurred. So I told you it's applied equals POHR times actual activity, because I like the AA. Applied uses actual activity, whereas the predetermined overhead rate uses estimates. Normal costing is a costing system which uses overhead costs that are applied to a job by multiplying the predetermined overhead rate by the actual activity. So that's exactly what we're doing in Chapter 2 and will continue to do in Chapter 3. We're using normal costing, which applies overhead based on actual activity. And then our job cost sheet is the form that we use to track the direct materials, direct labor, and applied overhead that is charged to a particular job. So now we're going to start taking a look at the cost flow of all of the materials, labor, and overhead costs as they move through the financial statements and records of a company. And we're going to whip up some fun and exciting T accounts as well. So get ready for that. Remember that there are various types of inventory that are included on a manufacturer's balance sheet. All items start as raw materials. That's before we do anything. Then as we start adding labor and overhead costs, but have not quite completed the product, it becomes work in process. And then once the goods have been completed, it becomes finished goods. And the cost of the goods that we've manufactured during the period would be all of the direct materials, direct labor, and overhead costs associated with the goods that were finished during that period. So here's a nice little visual of how costs flow through an accounting system. We start with our raw materials and direct labor costs, and our overhead costs, which are our product costs. The raw materials, before we touch them, are raw materials inventory that show up on our balance sheet. Then the direct materials that are used get added to work in process, as well as our labor and overhead. Remember, labor and overhead are our conversion costs. We learned that, I think, way back in Chapter 1. So those are how we convert raw materials to finished goods. So we add labor and overhead costs to our work in process, and then when we complete the work in process, it's considered what we call cost of goods manufactured, and that amount moves to the finished goods account. Then the finished goods, when sold, finally become cost of goods sold on our income statement. In addition to product costs, we also have period costs, which include the selling and administrative costs. Those are expensed directly in the period in which they're incurred, so those are going to go directly to our income statement. What we're going to learn in this chapter is how that flow of cost information goes through the accounting system of the entity. So to illustrate, we're going to look at Ruger Corporation's transactions for the month of April. They produced gold and silver commemorative medallions, and they were working on 2 jobs in April. Job A is a special minting of 1,000 gold medallions. Started during March and completed in April. As of March 31, Job A has been assigned $30,000 in manufacturing costs, which corresponds with the work in process balance at the beginning of the month. That $30,000, remember, would be direct materials, direct labor, and overhead costs that were added to the job in the month of March, and now are the beginning balance in work in process for the current month of April. Job B is 10,000 silver medallions commemorating the fall of the Berlin Wall. It started in April and was still incomplete at the end of the month. So it wouldn't have any beginning work in process balance as of April 1st because we just started it during this period. Before we get into all the fun and exciting that is job order costing, journal entries, and T accounts, I think it's probably a good idea to refresh your memory as to the debit and credit rules that you should have learned in 502. So remember the glorious accounting equation, assets equal liabilities plus equity. Then we have our income statement equation, revenues minus expenses equals net income. Within equity, we have contributed capital and retained earnings. Contributed capital is the amount from investors. Retained earnings is the amount we earn and keep inside our business. If we're not keeping them, we're giving away to the owners in the form of dividends. So we can draw a T under each one. That's what a T account is, just a letter T. And then we have to remember the nation's capital, which is Washington, D.C. That reminds us that debits are always on the left, credits are always on the right. And then change my color, get fancy. We have to remember this word here, dead, because you will be dead if you don't remember this. So we need to debit expenses, assets, and dividends to make them go up. I don't know what I'm spelling here, dividends, which means those are the accounts that are going to go up, down. So expenses go up, down, assets go up, down, and dividends go up, down. Everything else goes in the opposite direction, which the opposite of up, down would be down, up, down, up, down, up, down, up, down, up. So if you had me for 502, I would have taught you that we first think in English, which is which accounts are involved and do they go up or down, and then we convert that to accounting language by using this conversion guide, which will help us determine if we need a debit or a credit. We're mostly going to be dealing with assets and expenses. There'll be some other accounts involved as well from time to time. But if we're dealing with assets or expenses and we want it to go up, according to the rules, we debit them. If we want the account to go down, we would credit them. If we're dealing with other accounts, you just look at the arrows, like liabilities would go up with credits and down with debits. So you're going to want to use this conversion guide to refresh your memory of all that delightful knowledge you should have learned in 502. Probably thought you'd never use it again. Well, guess what? You need it. So we're going to start with the beginning of the production process, and logic would tell you that the beginning of the process starts with materials. So when we buy materials, materials would enter into the material account. So remember the rules we just talked about? I'll try to get real fancy and use the same colors that I had on the previous slide. So for assets, assets go up with debits and down with credits. Everything on this page is an asset. So raw materials, work in process, and overhead accounts are all assets. So when we buy raw materials, that adds to our raw materials account, which is why you see a debit. And then when we use it, we take it out of the account. So it's in and out, in and out. So direct materials are the ones that we can directly trace to our product. So those would go directly into work in process. So they come out of raw materials with a credit and they go into work in process with a debit. Out and in. Indirect materials would be things like the solder we might use to put together the iPhone, the grease we use in our machines. We can't directly trace it to our product, so instead we shove it in the overhead bucket to allocate later. So it comes out of raw materials, the indirect, out, and goes into overhead, in, out, and in, out, and in. And we're just using our debit credit rules for assets, which out is minus on the credit side and in is plus on the debit side. So that's how the cost flow works with our T accounts. So let's go through and journalize those. So first we'll start with purchasing raw materials. So on April 1, Ruger Corporation had 7,000 of raw materials on hand. During the month, they purchased 60,000. So if they bought materials, they're going to have materials go up, which means debit, and then it's on account, which you got to remember from 502 means that we haven't paid for it yet, so our liability is going to go up. So the journal entry is going to look like this. Raw materials go up because it's an asset, and assets go up with debits, and then our liabilities go up. Our liabilities go up with credits. If you go back to your conversion guide, I'll do it this once, just this once. Assets do go up with debits and liabilities do go up with credits. How exciting. And guess what? Debits equal credits, which if you remember from 502 is very, very important. So that gives me comfort that we've done the entry correctly. Moving on, we're now going to use materials. So a materials requisition form tells us how much is being used. 52,000 in total is being used. 50,000 is direct, 2,000 is indirect. So we should remember from moments ago that the direct materials go right into WIP, the indirect go into overhead. The total 52 is going to come out of our raw materials. So to come out of an asset, we credit the raw materials account to make the asset go down. And then to go into our WIP, the direct materials goes in there with a debit to WIP. The indirect materials go into overhead with a debit to the overhead account. Because these are all assets, debits make them go up and credits make them go down. So we're just taking out of one bucket and putting it into another. Out and in. Out and in. That's all we're doing here. Let's move on to labor. Oh, I know the excitement. You can hardly contain it, but it's very similar. We're taking it out of labor, in this case, our wages payable, and putting the direct labor into the WIP account. So let's refresh our memory how these accounts work. Liabilities go out with debits and in with credits. And then we have assets, WIP, our plus on the debit, minus on the credit, and overhead. Plus on the debit and minus on the credit. So the direct labor is going to go into salaries payable if I don't pay it because I owe the money. And then we add the direct or trace it to our work in process account. Indirect goes into the manufacturing overhead account. So in journal entry form, if we had 60,000 recorded as direct labor and 15 for indirect labor, what we would do is put the direct labor into WIP, which to increase assets, we debit it. The indirect labor into overhead. To increase assets, we debit that. And then the total 75,000 would increase my salary and wages payable liability. Or we could also be crediting cash to decrease that asset.